Marji, a very warm welcome to our channel. And first of all, if you would like to give an overview about the Q4 numbers.
Thank you for having me on your show. First of all, okay, and we are very satisfied and happy with the recovery that we saw in Q4, largely with respect to our margins. Okay, our margins improved in Q4, as you also mentioned, by close to a little over about 420 basis points over the previous quarter, and even at a higher level compared to the same period of last year, that is year on year. And after about 7-8 quarters, we have reached double-digit margins. Okay, and in addition to that, in Q4, we also managed to bring our debt down by about 250 crores. We made some good progress in bringing efficiencies further in working capital that help also to unlock some cash. The growth has been across most business units. What I mean by business units is that we grew in the aftermarket, we grew in exports, we grew in OEMs, both year on year and quarter on quarter in Q4. On a full year basis, we ended the year with a little over 20.1% of top line growth. And towards the end of the year, we managed to bring our margins back. So it's been a very satisfying year. And with respect to our debt, overall on a full year basis, we spent our capex of about 900 crores as per our original plan. And we managed to fund it entire capex from our own internal accruals. Our debt levels marginally declined by end of the year versus where we started in the beginning of the year. So overall, a satisfying year is what I would like to say.
Okay. Going forward, how do you think the margins levels would be maintained? Because in this current year, current quarter, you got the benefit of low raw material prices. What are the margin levels which you see in future, which are sustainable for the next quarter and the year?
Raw material prices play some role with respect to our margins. And you are aware, we had continuously about 8 to 10 quarters of continuous increase in raw material prices quarter on quarter. Since October 2020 onwards, the prices have been moving in one direction. And so generally, there is always a lag. Whenever raw material prices goes up, raw material prices go up. Okay, with the lag, the tire prices would move. And when the price input costs increase continuously, it's difficult to pass on the entire incidence of raw material prices. So that was one of the reasons as to why our margins dropped during this intervening period. Okay, in Q4, we saw raw material prices correcting to a reasonable level. Crude today is hovering in the range of about $75 to $80. And other commodity prices have also corrected, though natural rubber prices have seen some uptrend in the last 4 weeks. In general, we are comfortable at current levels of margins. So in generally, 12% plus or minus 1% is the range at which, in the short term and medium term, helps us to manage all our capex requirements and other things. So that is the level that we're generally comfortable. Over a medium and long term, though, we would like the margins to move up. Coming into Q1, okay, in general, raw material prices are range bound. Okay, we are able to hold on to our tire prices. And in Q1, generally our advertisement or marketing cost is a little higher. So from that point of view, it may have some impact on our operating costs, and any movement in raw material costs may have some impact on our margin, but it should be within the range as far as the Q1 is concerned. Beyond that, I'm not able to say, but it all depends on how things unfold. There are other things that influence margins like top line.
Because we are short of time, sir. Sorry about that. But one last question. The volume growth has been really healthy, or if you see quarter on quarter basis or year on year basis. And plus, you have said that exports are also looking good in future. What do you foresee? How would it expand in the next year?
No, last year was a tough year as far as exports is concerned. Okay, and so therefore on a lower base, we expect going into FY24, that is FY23-24 to be better. Okay, and on a lower base, we see some recovery things look positive, though it's very early to say. And OEMs, we grew strongly last year. We expected to sustain some growth over this last year because we see passenger car segment is doing well, and also commercial vehicles are doing well. Replacement is, sustaining at some level. So overall, we look forward to some level of growth in exports and OEMs in FY24.
Okay, sir.
It largely would be volume driven, and how much would be price driven is difficult to say.
Absolutely. On that note, sir, thank you so much for joining with us and sharing your views, and all the very best for the next quarter and the next year too.
Thank you. Thanks a lot.